Welcome to the Straits Financial presentation, Beyond Traditional Portfolio Diversification with Managed Futures. Today we're going to address the potential for portfolio diversification and balancing risk through participation in professionally managed futures. We encourage you to take notes and write down any questions throughout this presentation that we can address with you at your convenience. Consider the state of the stock market over the past 25 to 35 years. Now imagine if over the past 5 worst period declines for stocks since 1987, you could make positive returns in your investment portfolio. Or imagine if your investments could outperform stocks during the most critical events of the last 4 decades. This is a potential benefit of diversification through managed futures. A commonly used index of managed futures, the Barclay Hedge Index, has been 100% positive during the very worst stock market decline since 1987. And this index of managed futures outperforms stocks by 31%, as calculated by using the S&P 500 Total Return Index, and international stocks by 916%, as calculated by using the MSCI EAFE Index. As we continue, I will validate these findings and hopefully pique your interest regarding the use of managed futures in your portfolio. Trading futures and options involves significant risk of loss and is not appropriate for every investor. Past performance is not necessarily indicative of future results. For many of you watching this presentation, this may be the first time you are being introduced to managed futures. For this reason, let me first clarify what managed futures are. Managed futures is an investment class involving investing with a manager who will use futures or options on futures to obtain returns. This may provide an opportunity for diversification in a way not typical of traditional stock and bond portfolios, which have been used by institutions, pensions, endowments, and high net worth investors to diversify portfolios for more than 30 years. The managed futures industry is comprised of professional money managers known as commodity trading advisors, CTAs, whose trading strategies use futures and options on futures in the client's managed account. Each CTA may use a unique trading system, usually through the analysis of fundamental or technical factors. Each CTA must be registered as a commodity trading advisor with the National Futures Association, NFA, the industry's self-regulatory organization authorized by Congress in 1982, or the CTA must have filed an exemption with the NFA. Individual CTAs are required to describe trading strategies and past performances in annual disclosure documents that are filed with the NFA and must be provided to investors unless the CTA has an exemption from the NFA. Exempt CTAs can only offer services to high net worth individuals and other qualified eligible persons. Managed futures CTAs typically provide the dual benefit of a full-time commitment to trading and a disciplined approach to trading. CTAs use strategies to attempt to minimize risk, control losses, and protect profits. Commodity trading advisors offer investors some benefits similar to those experienced with mutual funds and other investment advisors. These benefits include a full-time commitment to the markets and their trading programs, a disciplined trading approach with risk management strategies that attempt to control losses and protect profits, as well as trading and risk management strategies that endeavor to balance risk with reward. Although both managed futures and mutual funds have similarities, such as offering diversification to a portfolio, being professionally managed and regulated by governing bodies, both have the potential to profit in a bull market. A huge difference is how managed futures may have the potential to profit in sideways or bear markets. Most typical equity mutual funds sustain losses in a bear market because they have a long-only strategy. Diversifying a portion of your investment portfolio into managed futures may enhance your portfolio with investments that take advantage of up, down, and sideways markets. Managed futures strategies can be traded in several account types at a Futures Commission Merchant, FCM, including individual, joint, corporate, and partnership accounts. They can also be included in retirement plans, IRAs, trusts, and pensions, much like mutual funds. Trading futures and options involves significant risk of loss and is not appropriate for every investor. Past performance is not necessarily indicative of future results. Is your portfolio currently designed to perform well in any type of market condition? A well-balanced managed futures portfolio using multiple CTAs may potentially provide a diversified global investment opportunity for investors. Potential for risk reduction, potential to reduce portfolio volatility, potential global diversification through participation in global markets, potentially enhancing a portfolio's returns, and the potential to profit in both rising and falling markets. Please be advised, the addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of any individual CTA. Investing in a managed futures portfolio may offer the opportunity to reduce the volatility risk of a portfolio by diversifying your asset classes. Dr. Harry M. Markowitz, a Nobel Prize-winning economist who developed modern portfolio theory, stated that diversifying across asset classes that have low to negative correlations to each other has the potential to increase a portfolio's efficiency. A managed futures portfolio may help achieve this goal by decreasing an investment portfolio's overall volatility risk through the addition of another asset class. Trading futures and options involves significant risk of loss and is not appropriate for every investor. Past performance is not necessarily indicative of future results. A big reason why managed futures reduce the volatility risk of a portfolio is that as an asset class, a diversified managed futures portfolio may show low or negative correlation with other asset classes. From this table, we can see the asset class correlation comparison between the S&P 500 Total Return Index, Barclays U.S. Aggregate Bond Index, and the Autumn Gold CTA Index. The values range from 1.0, which means the asset classes behave the same, to negative 1.0, which means they act exactly opposite of each other. We see in this table that as a group, CTA indices don't behave the same as the indices of S&P 500 and bonds. Thus, inclusion of the managed futures asset class may help reduce the risk in a rapidly falling or rising market, as we'll see later on in this presentation. Remember, it is not possible to directly invest in these indices, and their returns do not reflect the fees and expenses inherent in investing in a vehicle designed to replicate a particular index. The addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of an individual CTA. While managed futures may reduce the volatility risk of a portfolio by having low correlation to other asset classes, they may also potentially add the opportunity to enhance your portfolio's returns. In a 1983 study, Dr. John Lintner found that managed futures compared favorably with stocks and bonds. He stated that the combined portfolios of stocks, or stocks and bonds, after including judicious investments in leveraged managed futures accounts, show substantially less risk at every possible level of expected return than portfolios of stocks or stocks and bonds alone. This is still true today. You can see in the chart below a traditional allocation using an index of 60% stocks and 40% bonds compared with an allocation that substitutes 20% into an index of managed futures. Through the years, the portfolio that included the index of managed futures outperforms that of the traditional one. There is a potential to increase returns in an investment portfolio by adding managed futures to a traditionally managed portfolio. Stocks are represented by the S&P 500 Total Return Index and reflect all sectors of the U.S. equity markets. Bonds are represented by the Barclays U.S. Aggregate Bond Index, and managed futures are represented by the Autumn Gold CTA Index. The Autumn Gold CTA Index is comprised of the client performance of the CTA programs included in the Autumn Gold database and does not represent the complete universe of CTAs. CTA programs with proprietary performance are not included. Remember, it is not possible to directly invest in these indices, and their returns do not reflect the fees and expenses inherent in investing in a vehicle designed to replicate a particular index. The addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of any individual CTA. Some CTAs provide the opportunity to participate in the global market. Global diversification could further reduce the volatile risk of an investment portfolio. Global instruments a CTA may invest in can include futures and energies, stock indices, metals, livestock, currencies, interest rates, agricultural products, and softs, to name a few. Managed futures have the potential to be profitable no matter which direction the markets move. As we compare gains between the S&P 500 Total Return Index and the Autumn Gold CTA Index, we can compare historic returns for this managed futures index. This chart shows Autumn Gold CTA Index performance when the S&P 500 Total Return Index had quarterly gains higher than 10%. The chart demonstrates that the Autumn Gold CTA Index produced gains or minimal losses during these historic periods, and the S&P 500 Total Return Index incurred gains as well. Remember, it is not possible to directly invest in these indices, and their returns do not reflect the fees and expenses inherent in investing in a vehicle designed to replicate a particular index. The addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of any individual CTA. Where managed futures may play a critical role in a diversified portfolio is in a falling market. For 30 years, the Autumn Gold CTA Index either outperformed or saw minimal losses whenever the S&P 500 Total Return Index experienced quarterly losses greater than 10%. When a portfolio with only stocks and bonds hits a falling market, they would only see losses, while allocating investments into managed futures provides the potential to create gains during bearish periods, both from CTA's potential to trade products with lower correlation to equities and bonds, and the ability for the CTA to establish short as well as long positions under different market conditions. Remember, it is not possible to directly invest in these indices, and their returns do not reflect the fees and expenses inherent in investing in a vehicle designed to replicate a particular index. The addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of any individual CTA. To show you the potential of managed futures, consider the increased value of invested assets. This chart represents an initial investment of $10,000 in indices representing managed futures, U.S. stocks, and also international stocks. As we can see, during this period, the managed futures index outperformed both U.S. and international stocks and managed steady growth, while the other asset classes cycled through falls and rises, and the ability for the CTA to establish short as well as long positions under different market conditions. Remember, it is not possible to directly invest in these indices, and their returns do not reflect the fees and expenses inherent in investing in a vehicle designed to replicate a particular index. The addition of managed futures to a client's portfolio does not mean that a portfolio will be profitable, or that it will not experience substantial losses, and that the studies conducted in the past may not be indicative of current periods or the performance of any individual CTA. Please keep in mind that past performance is not indicative of future results. Now let's compare a traditional portfolio with stocks only to that of a diversified portfolio, including 20% invested in managed futures as represented by Barclay Hedge Index. As we can see in this chart for the drawdown figure, including managed futures in the portfolio of indices didn't affect the annual compound return, but it drastically reduced the worst drawdown. This can be attributed to the historic lack of correlation and also potential negative correlations that managed futures may bring to the portfolio. Stocks and managed futures may sometimes even move independently of each other, thereby increasing the spread of risk in a volatile market. This chart shows the potential that an index or potentially a diversified portfolio of managed futures could add to a diversified investment portfolio. Many critical events throughout U.S. history have influenced the U.S. economy. The red line indicates that throughout the years, several events have resulted in significant losses for the stock market. If we compare these same events with the performance of managed futures indices, we see that the impact of managed futures is negligible. Managed futures as an investment class may help maintain stability in your portfolio when these unexpected events occur. Bear in mind that the substantial risk of loss exists no matter who is managing your money. When you put money under management of a CTA, the potential exists in futures trading to lose more than your initial investment. When we consider the risk of an investment portfolio, we need to consider three things. We can look at volatility, expected shortfalls, or the value at risk. This value at risk is the maximum drawdown. As we've shown previously, managed futures may significantly reduce the worst cumulative loss in the value of an investment portfolio. This is reported as a drawdown. A drawdown is a peak-to-trough decline during a specific recorded period of an investment. Drawdowns are a natural cycle within any market, but the range of a drawdown can significantly impact the profits of an investment. It is usually quoted as a percentage between the peak and the next trough. As we can see in this figure, the CISDM CTA Equal Weighted Index of Managed Futures had a reduced worst drawdown when compared to traditional stocks, such as the Dow Jones, S&P 500, NASDAQ, and MSCI World Indexes. Harvard University boasts the largest endowment fund of any institution in the world. But did you know that commodity and financial futures-related instruments are regularly included in their portfolio? Jack Meyer, the former chief executive of the Harvard Endowment Fund, once said, "Holding managed futures offers protection against the ups and downs of stocks and bonds. They're the most diversifying asset in the portfolio. The benefits of diversification are indisputable. Diversification rules. It's powerful. And our portfolio is a good deal less risky with commodities than with only the S&P 500. A managed futures account, also known as a single managed account, SMA, is an individual account opened in the customer's name at a Futures Commission Merchant, FCM. Limited power of attorney is assigned to one CTA who makes all of the trading decisions in a customer account. This power of attorney may be withdrawn at any time. Investors may be able to diversify their portfolio by opening individual SMAs with a variety of different CTAs. Customers have full transparency and can view their accounts in real time through an online customer portal. You gain 100% access to all trading activity on your account 24/7. Track your account by receiving a complete accounting of all the activity in your account and get an account balance 24 hours a day through your account portal. Once you have opened up an account, you'll then gain access to the customer portal. This portal provides all the details you need in one central location. Benefits include secure access to account statements and balances. You'll be able to track and view your online statements and have a complete history of your balance. Submit ACH, check, and wire requests online. This allows you to request funds securely instead of relying on email. You can also view your request status in real time. Trade movement requests. Instead of emailing a request, our online process makes it quick and easy. Access to online application information. If you complete a futures account application online, you'll have the option to access your original account documents or process a new account application, market research, and information. Soon you'll have premium market information at your fingertips, exclusively for our customers. Again, we ask you the same question at the beginning of this presentation. Can your portfolio profit in any direction the market moves? Now that you have learned more about managed futures, you hopefully now have a clearer understanding of how you may be able to diversify your investment portfolio to optimize its performance and bring more stability to your investments in a volatile market. Diversification may be the ticket to successful trading in today's global economy. With uncorrelated asset classes, like an index of managed futures, there is a potential to cushion your portfolio to ride out the dips and valleys of the economy as reflected in investments in stocks and bonds. Now that you have been introduced to the benefits of professionally managed futures, we would like to answer any questions you may have and provide you with further information for review. Please contact your Straits Financial introducing broker or contact the Managed Futures Division directly.